Okay, thank you guys for attending. Appreciate it. My name is Mark Perlow. I'm Senior Director at AST Defeasance. I oversee the New York office for pretty much all things regarding defeasance, yield maintenance, and interest rate hedging. I have over here John Kautz with me, one of my partners. John held key roles at firms both large and small, Bank of America, Commonwealth Bank of Australia. While at CBA, John served as Director of their Institutional Banking and Market Division, where he oversaw CBA's derivative business. His extensive background in interest rate derivatives, sales and trading, and all that stuff have really been in very high demand for presentations and workshops as borrowers, lenders, and brokers navigate all aspects of floating rate needs. So it's really a pleasure that we have John with us today. We're going to try and take, everyone through the overall and just touch on high level defeasance, yield maintenance, and interest rate caps, also touching on floors and different strategies that we've been seeing in the market today that will hopefully help borrowers and really anyone else navigate their way through a complicated time in commercial real estate and commercial real estate finance. So to begin with, we're going to begin with on the defeasance side, and then we'll touch on yield maintenance. So if you guys look at the first slide, I don't have any screens or anything, but we did print out a bunch of these different PowerPoints that you guys can take a look at as we go through it. And of course, please feel free to ask questions. So the first thing we want to touch on is a very common question we get from borrowers and really from brokers and anyone else in the industry is, what's defeasance? What's yield maintenance? What's the difference? What should we aim for? What's the better one to get involved with? So with that in mind, we wanted to just break down very, very quickly what the difference is between the two of them. So defeasance is a substitution of collateral. For the sponsors, it really meets the same end goal as a traditional payoff. However, the way that it's done is through a very, very different process. So on a yield maintenance, what you're getting is 30 days before closing, you're going to get a payoff statement from your servicer. That's going to have exactly how much you owe. Whereas a defeasance, because it's a substitution of collateral that's completely market dependent, you only find out the amount that the defeasance is going to cost 1 day prior to closing. Now, the benefits and the negatives are that, especially in today's current environment, the benefits of a defeasance versus a yield maintenance is that a defeasance is limitless potential when interest rates rise. Whereas a yield maintenance, you will always have a 1% floor on the prepayment penalty associated with it. So, for example, in today's day and age where most of the times treasuries are yielding greater than what the coupon on the loan is, you're able to have what's called the defeasance savings, and that's something that we'll discuss in a moment. The only other items that I would mention in terms of the differentiation between a defeasance and yield maintenance is that at defeasance, you have a 24-month lockout period, which means that typically in the first 2 years of the loan, you cannot prepay your loan in any fashion, whether through a defeasance or not. But you could close your loan at any time, whereas a yield maintenance, you typically have to close on the first day of the month or on a payment date for it. So it allows a little bit less flexibility in the actual closing of a yield maintenance. Which brings us to slide number 2 and something that I touched on just before, and that's a money-making defeasance and negative defeasance. So today is something that we've really only seen once or twice before in the past, and it is the allowance to pay underneath your principal balance at the time of defeasance. So, for example, if you guys take a look at example on the right, it is a case where you have a principal balance at defeasance for $16.5 million. Now, due to the increased rate in treasuries, you no longer have to pay off the complete $16.5 million. You'll be able to only pay this off with a total amount of $15,687,000. So you are effectively paying less than the outstanding principal balance in order to get out of your loan. Now, why is that very beneficial? It allows for different opportunities such as an artificial cash and refi. So if you do have to refinance your loan, then you're able to pull out, in this example, almost $800,000 less, and you're able to utilize that for any future deals that you guys are currently working on. Now, how does it actually play a role in what we're seeing day to day? As an example, most borrowers, they have to have a reason to move. And it doesn't make a lot of sense to them for them to necessarily defease their loan earlier than what's actually necessary. They're in fixed rate debt, they have a year or two left on it, ride it out. So this is one of the ways that you're able to really utilize defeasance to your advantage in order to allow for it, for it to take advantage of the known. Right now, you know exactly what the new 10-year rate would look like. You could lock yourself in. And due to the increase in rates, obviously, it is a bittersweet victory that, a negative defeasance, but due to the increased rates, it's allowing you to have some sort of cost benefit with prepaying the loan at that time. Again, you'll see on the left the different do's and don'ts and things to keep in mind on defeasance, but the most important one and the most common one we get on the bottom, is on the bottom left, is that, does that mean that the servicer will pay us money at the time of defeasance? That's not what's happening. You're never going to get a check for the amount of differential from the servicer. It's just when we are buying securities for the defeasance, instead of buying the entire $16.5 million in the portfolio, we'll only have to buy, like I said, the $15.687 million. Yes?
Does it make a difference when you pay it off? In other words, if there's 4 months left or 5 years left, if you're saying that you pay it at the 15.6 versus the 16.5, is that based upon a certain time limit?
Sure. So defeasance will always, the bulk of every defeasance cost, and if you notice over here that there's one real bulk item, that's the securities cost. That's a replacement cost for what the principal and outstanding balance is owed. The rest of them are all third parties. So in regarding to the timeline, that's going to most impact the actual securities cost, because what we're doing is, obviously with most of these loans, you have a huge balloon payment at the end, which means that the maturing treasury at the balloon payment, that is at the same time as the balloon payment, is going to be the most impactful in the cost of the defeasance. So depending on where that balloon is yielding, that's going to be where we're pulling most of it from, and thereby the greatest effector of how much it is to the cost for the defeasance. So we know what you're saying, that if you end up defeasing it 5 years early or 4 years early, we're going to be looking at that maturing treasury that corresponds to that amount of time and using that for the bulk of the payment for the defeasance. So it absolutely does cost it. So imagine now, a real world example is if you've already burned off 8 years, we'd be looking at a 2-year treasury. And obviously, if you have 25 months left on your loan, it's not going to be exactly the 2-year treasury, but for a good ballpark of for what to look for, you're going to see the 2-year treasury, be able to see that, and that's where we're going to calculate the defeasance costs from. Again, in a very back of the envelope type of estimate. Obviously, when you guys reach out to us and give us the defeasance or the property address, that's all we need to quote a defeasance, a property address, and a closing date. We're obviously running a much more substantive estimate for that.
Can you re-explain where that gap money goes?
Sure.
You don't get cut a check. Can you just explain again, where does it go?
Absolutely. So in order to really explain that, I guess, and I didn't flesh it out completely, is to discuss what's happening in a defeasance. So what's happening in a defeasance is that since it's not a payoff, it's a substitution of collateral. It means that we just have to make the bondholders whole at the end of the day. So there's going to be monthly payments happening until maturity. The question is, where are those monthly payments coming from? Are they coming from the principal and interest that you guys are paying every single month? Or is it coming from the substitution of collateral? So what we're doing is we are pooling together treasuries that meet the same yield, that mimic that yield, and those are going to be the treasuries that are making those monthly payments. So now when we're pooling together treasuries that have to make those payments whole, the greater the higher the interest or the higher the coupon is on the treasuries that we're actually procuring, the less of them we have to buy. So when we're defeasing, we need to meet $16.5 million worth of payments. Now, when we're buying that amount of treasuries at the current rate, in order to make $16.5 million worth of payments, we only have to procure $15.687 million worth of treasuries, and then those treasuries maturing twice monthly and making those payments monthly are going to meet the $16.5 million. So you're not getting a check back from the servicer to pay for the defeasance or to help pay for the defeasance, but we just need less cash from you to buy those bonds today. So you are walking away in what's called a negative defeasance, but obviously no money is actually entering into your pocket. You just have less of a capital outlay in order to do the defeasance.
So if I had a $35 million loan at 4%, and today the rates are 6.5, 6.25, I have 5 years left, and I'm selling the property. So I'm going to pay off the loan. This is a case where this defeasance would come into play, and it says I would not have to pay, let's assume it was a $34 million, I could pay 32, 31.
Yes.
million to pay off the loan.
Yeah, so
Defeasance.
because usually, again, where are you getting the funds from? You're getting them from a refinance or a sale.
Got it.
So when you are paying for, when that money's coming in on the refi, instead of taking $35 million that we would usually need to do the defeasance, we're only taking $32 million in order to pay for that defeasance cost.
You could save $2 million on the if it's defeasance.
But they have to pay for
No, they have to take it, right? The mortgage, the guy that holds the mortgage, he has to take, it's not like, you're basically getting a discount for paying, under those circumstances, paying. He can't say, no, you gotta pay me more or add more things on it, right? He has to, that's what he has to.
Yeah, so it's bondholders, there's no one even realizes that a defeasance is being done, because again, those monthly payments are continuing. So from the sponsor's perspective, the borrower's perspective, they're walking away free and clear, but from the bondholder's perspective, unless they're even looking in Bloomberg, they're not even aware that there's fees. The monthly cash flows are still coming in.
Right, but on a yield maintenance, you said there's a 1%, even if rates went up or something, you still have, in other words, you're not getting that discount, are you?
Correct. This is one of the few times that I've been in the industry where people are like, yes, I have a defeasance, instead of, oh, phew, thank God I don't have to deal with the defeasance in this transaction, where yield maintenance is less beneficial than a defeasance in today's environment with the higher interest rates. So you certainly are being able to benefit from the cost, from the higher interest rates. Obviously, again, this is just finding the silver lining on the current environment and utilizing it to the sponsor's advantage, or thinking a little bit outside the box on the defeasance. Really, that's kind of covers the portion of yield maintenance and defeasance. Obviously, if there's any other questions, feel free to ask me. But I'll hand over the next slide to John to just start introducing the interest rate cap products.
Thanks, Mark. Yeah, good afternoon, everybody. Thanks for coming. Definitely ask questions if you have them, but I would point out we've got a lot to get through and not a ton of time. So I just want to let everybody know I will be here the rest of the day. I'll stay after this session. I'll be here tomorrow as well if you have any specific situations you want to discuss. As Mark mentioned, my entire career background has been in derivatives as a trader and as a marketer. I just celebrated 35 years in the industry in July. It's a pleasure to be at RCA. I've been here now almost 2 years, previously at Commonwealth Bank of Australia running their derivatives desk. So I think we'll just dive right in. I think what I'll do before we do the first slide is just a quick overview of what we saw last week with the Fed. Basically, the Fed held the overnight rate unchanged and also signaled that they are prepared now to move to what's called a meeting-by-meeting bias, which means right now they're not biased to the higher side or to the lower side. They're not really hawkish or dovish right now, they're kind of neutral. What that probably means is the overnight rate is going to sit right where it is for a while. Market pricing has a chance of a Fed rate hike in December at near zero, less than 5%. But beyond that, there is some lingering fear that if inflation ticks back up, and the Fed was clear about this last week, including Powell, I don't think they will hesitate to pull that last 25 that they have in their back pocket out and raise rates again. So I think that's what we're seeing a little bit today. After that announcement, we saw rates go down 10 or 12, 15 basis points pretty significantly. That was followed up by a further rate drop after Friday's employment figures, which was more of a relief because what the Fed wants to see now is the employment market cooling down a little bit so that hopefully wage inflation stays where it is. Wage inflation tends to be more entrenched than goods and services inflation, so the Fed watches that very carefully, and that's why kind of what they do in the employment market are pretty closely tied together. So right now what we have is a Fed on hold. Powell himself, when asked, said the FOMC is not contemplating rate cuts right now. So my view is that the market's still a little bit ahead of itself in terms of calling for rate cuts kind of the middle of next year. I think the market's making a mistake in that the Fed doesn't just ease rates because they're on some kind of predetermined schedule. The FOMC will need a compelling reason to lower rates. What I think that reason would be some type of significant deterioration in the economy, which by all measurements, I'm sure you saw the GDP figure a few weeks ago, by all measurements is still humming along. There are some signs on the horizon of maybe a little softening, but I think the consensus is still that right now we're kind of headed for a soft landing. So what I point out is we are by no means out of the woods with Fed activity. It could be a volatile year. Keep in mind too, you've also been seeing the back end of the curve is moving much more volatile than the front end of the curve, right? You might see 1 year, 2 year swap rates move up, 1 year, 2 year treasuries, but what you're seeing, say, at 5 year, 10 year, 30 year bonds is a much more pronounced volatility than we're seeing on the short end. And as we saw recently, and until last week, rates on the back end of the curve had surged. I mean, I think the 10-year note from the September Fed meeting was up like 110 basis points. So I guess I only point that out to say that I expect volatile markets. I don't think I'm ready to say I expect a stabilization in the market. Even if the Fed is not actively doing something, the market and the traders in the market will be kind of trying to figure it out for them. So I guess the takeaway from the Fed and the market is expect further volatility, and we are by no means, out of the woods in terms of this inflation fight. I was actually frankly surprised that the Fed didn't mention it more, because the inflation numbers have just been kind of sticky right here and even kind of ticking up a little bit. So as long as they don't get out of control, I expect the Fed to just monitor and wait until they have more concrete economic data to make a decision. That may be the next time we see GDP. That may be the next round of CPI and PPI inflation data. So the Fed will be very data dependent, meeting by meeting bias, but in my opinion, make no mistake, if they feel that they're going to repeat the Volcker era, stop tightening too soon and fan inflation, they're going to do something to stop that. All right, so digging back into the presentation, and I'll move quickly through a lot of these slides. There's one I really want to focus on in particular. The primary hedging products that we are helping borrowers, we're facilitators as the advisor, are still interest rate caps or derivatives of interest rate caps and interest rate swaps. To talk about the interest rate cap, if you look at that slide, and again, I'll spend just 2 minutes on this. With an interest rate cap, you have a variable rate exposure. You've taken a variable rate loan. In most cases, the lender will mandate a hedge. Most borrowers gravitate to the caps because you pay a one-time upfront premium. That's the extent of your liability. There's no two-way mark-to-market or anything like there is on a swap. So it's very neat and tidy. You pay your premium. Again, you can never have a negative mark-to-market. You can only unwind that cap going forward at 0 or at a positive value if it moves in your favor. What you're paying for with that premium is to set a ceiling on that variable rate. In the case of SOFR, let's say you wanted to cap SOFR at 5%. That would be called the strike rate on the cap. You would purchase a 5% cap for whatever the term of the loan that the lender is requiring you to hedge. Let's say it's 2 years or 3 years. And in exchange for that premium, should SOFR move above 5% at the end of each interest period, from whenever it crosses over, you'll get paid the difference. So if the next month, after SOFR touches 5, let's say it goes to 6%. Let's hope that doesn't happen, but let's say it does, you get paid that 100 basis points difference at the end of the month. Essentially, that caps that floating rate. It can never go higher than that. If you take your strike rate on your cap and you add your loan spread, you can basically back into what your max rate would be in that scenario. You've got a 5% cap, you're borrowing at 350 over, you're going to have an 850 max rate in that situation. Two important things to note with caps. When you're talking about how they're priced, the two main components are forward rates and interest rate volatility. When you're talking about caps that are below where the current level of SOFR is, right? Those are called in-the-money caps. So term SOFR is at 534 or something this morning. Any cap struck below that would be considered in the money. So if you want to buy a 3% cap, that would be far more expensive than buying something that's closer to where SOFR is. And that's because the cap that has the 3% strike has mostly intrinsic value, meaning when they price that cap, they know the premium you're paying is pretty much going to be paid back out over the life of that cap. So those caps, when you're buying what they call deep in the money strikes, under where SOFR is, are going to be less to do with volatility and more to do with rates. As rates move up, and it looks like the cap will pay out more, cap premiums get more expensive, your cap value will increase on your existing caps. As rates drop, it will price that, well, the payout might be less, So the value of the cap or the price of the cap will drop. When you're talking about caps that are at SOFR or above, as normally people would look at, but right now where we are in the rate cycle, that's tough to do and still have some of these deals make sense. That is far more dependent on volatility. By volatility, I mean how fast rates are moving up and down. Traders will actually assign a numerical value to that. It's called implied volatility. The higher that number is, the more uncertain traders are with where rates are going to go, and that's why volatility moves up, because they just feel like, there's going to be a lot more room for rates to move around. That will drive cap pricing as well, but that's more important for caps that are either where SOFR are at or above that. Say it's 550 or 6% cap. All right, so again, I'm going to move through this quickly. Moving on to interest rate swaps. Unlike a cap where you pay an upfront premium, that's the extent of your liability, and then you are paid the differential if SOFR should surpass your strike rate. An interest rate swap has no upfront premium. This is a coupon-based derivative where instead of you picking a strike and then paying an upfront premium, you will be provided a rate by the swap provider. So unlike a cap where if rates are below your strike, you would borrow at the prevailing lower rates, with a swap, day one when you lock into that, you're on the hook for paying the fixed rate on the swap. So let's say that swap rate is 5%. Now swaps are, as I mentioned, a two-way cash flow instrument. So the swap provider is paying you SOFR in exchange for the fixed rate that you're paying. So with that 5% example, if next month SOFR went to 10%, but you're paying 5% on your swap, you would get that 500 basis points from the swap provider, essentially fixing you at the swap rate no matter where rates move. Conversely, with a swap, if rates move below your swap rate, so let's say in that example, rates went from 5 to 4%, then you would pay the 100 basis points difference between SOFR and the swap, again, essentially fixing you at that swap rate. Unlike a cap, no upfront premium, you're quoted a mid-market rate and then a margin over that rate. Let's say it's 20 basis points over mid-market, that will be your swap rate. Unlike a cap though, this will have a two-way make-whole, meaning if swap rates are lower and you want to break it early, you will have to pay to unwind that swap. When you do a swap, you're provided all that information up front, so you should know what your scenario analysis looks like. Well, if I have a 5-year swap and I break it 3 years in and rates have moved 100 basis points, what will my swap be worth? That information should be provided by your advisor or swap provider at all times. The only other thing I point out which makes these slightly more challenging to place than caps is because of that two-way make-whole, there is a credit component, right? They have to account for the fact that you may default on the swap at the worst possible time for rates, generating that negative mark-to-market. If you default and can't pay that, they have to make sure that they have credit reserves for that. So many times we see swaps negotiated with lenders, but we can get them done in the market. You will probably need to be prepared to offer some type of additional or alternate security on the swap. Lenders aren't going to share their security on the loan, and with the credit environment the way it is, in many times we see that that's more of like a fully collateralized basis, meaning like, yes, we'll do the swap, well, you have to collateralize that exposure. Yes, sir?
Can you do a straddle? That would lower the collateral you need to put up in other words, if I want to keep it, so I'm doing a 5 and a 4, let's say, so now I had this 1 percentage point
You could.
anyways, and then I would have to put up.
You could, and many people, I didn't put it in this presentation, but a lot of people will use a collar for that as well, it's called.
Yeah.
Or, to your point, they'll use two swaptions to basically achieve the strat. But that's maybe derivatives 201 next year. I just didn't have time to put that in there. But really, I wanted to move on to the next slide, which is really the one we wanted to focus on. This really will dig into what we're seeing in the market. I guess just as a backdrop, and if you have interest rate caps, I'm sure these topics are not new to you, but interest rate premiums are extremely expensive right now and have been for some time. That is putting pressure on, obviously, new deal caps where we see them. It's putting pressure on cap extensions, which is a big question for a lot of our clients. I have a cap due for renewal, the loan's extending, I need to purchase a cap extension. When do I do it? How do I structure it? is it worth extending now and locking in the forward extension today and not worrying about it? So we're seeing a lot of clients worried about extensions and what they should do. We've got a whole slide on that in a moment, so I'll skip over that. I would just point out again, and I know I covered this, but as I said, this is still a very uncertain time for the rate market. I've heard people describe it as a turning point for rates. I think I would choose the expression, it's a crossroads, because we are by no means out of the woods on higher rates. So I don't think it's a turning point in terms of, rates are going to start to head back down anytime soon, but we are certainly at a crossroads here for what's next. Is inflation really stable and the Fed can back off? Is the economy really doing as well as we think it is, and there'll be that soft landing or not? Those questions are going to have a great deal of impact on where rates are headed this year. All right, so as I mentioned with the cap extensions, we'll cover that in a moment, but really what I want to stress on all of the things on this page is we can help you with this type of analysis. I think this is a critical time for borrowers who have rate derivatives to have a hedging advisor. So I would strongly urge you to consider that if you don't, because what we're spending the bulk of our day on now is analyzing individual scenarios for clients to try to come up with the best and optimal solution for them. Now, the other thing that I didn't mention about caps is, which is important, many lenders mandate caps. There's no choice. So the lender controls the cap. So even though cap premiums are going up and your strike isn't, and that's getting more and more expensive, lenders still have kind of the final say for term and strike on a cap. So when you're talking about extensions, we can only be as flexible as the lender will let us, but what we try to do is give you the ammunition to be able to have those conversations with your lender, and many times we're even involved in those conversations. And that would be, how can we alleviate some of the premium pressure? Is there a way to shorten the tenor of the extension and give us a break? And like I said, we're going to get into that in the next slide. One of the other main topics we're seeing right now is if you have an agency cap, or even with certain lenders, with the surge in cap premiums, what we saw is lenders be willing to shorten up that initial term requirement on the hedge. So maybe it's a 3-year initial term. Rather than forcing you to pay up for the 3-year premium, they would say, we'll let you do a 2-year cap, but you're going to have to escrow each month for the replacement cap that's coming up. Now, if it was simply where the forward cap price is, that would be a little cheaper, but what happens is they usually price a cap today and put some kind of buffer in there. So sometimes it's like 125% of where premiums are today. So what that has done, as the cost of cap premiums will go up, because many times that escrow is recalculated periodically, monthly, quarterly, semi-annually, and will either be topped up if need be. They usually don't return the escrow until you actually buy the cap, but they will top up the requirement if cap prices are increasing. So this is putting a lot of pressure on our clients. We actually just put out a whole one-pager on this. There's no easy answer, but there are some solutions that could possibly work. Restructuring the existing cap could give you, free up some cash flow by, say, hiring the strike on your existing cap, shortening the tenor. But again, that's a very short-term fix for clients who are maybe in more dire straits than some of their colleagues. Because whenever you change a cap, you'll have to deal with that on the back end, and you're simply just creating additional risk. So if you shorten your cap, you might get that little cash flow boost from doing that, but then you may still have another escrow requirement now to cover that portion of the cap that you unwound. Or you may have additional interest expense going forward if you raise your cap rate from, say, 2% to 3%. Now you've got to pay up to 3%, so that's an extra 100 basis points of interest expense that you have to account for. So the easy way to do that is to take the escrow balance and buy your cap now. So what we're urging clients to do is just to be vigilant. That doesn't mean tomorrow you have to liquidate the escrow and say, I want to buy my cap, but maybe start to ask for indications, see where that extension is pricing. And you may see an opportunity that makes sense. It may fall into a range that you budgeted for your extension. And that's something else I urge my cap clients to look at. Do you have a budget that you're working with here for a cap? That can sometimes help us structure the right cap for you. But short of, again, restructuring your existing cap, or simply just liquidating that escrow fund and purchasing a cap, those escrow funds are likely to remain somewhat painful for the near term, because even if rates sit here, they're certainly not going to reduce, but they'll be maintained kind of at current levels. All right, as we mentioned, we are definitely seeing an increase in interest rate swaps. What happened with swaps is, after the global financial crisis in 2008, rates plummeted, spreads blew out, clients were trapped in swaps that had tremendous negative mark-to-market. Some of them were getting margin calls, collateral calls. Others just could not refi or have the flexibility they would like to do anything about it, because credit spreads had moved out so fast that they couldn't refi. So they were stuck in these cumbersome swaps, and it was a nightmare there for a couple of years. Basically, the way swaps are structured now and the way the clearinghouse operates interbank, swaps are definitely safer to do. Counterparty risk has been largely mitigated to an extent. But you still have to make sure you're on top of some of the points we pointed out earlier, such as that negative mark-to-market, things of that nature. But slowly over time, what happened was people said, well, yeah, these cap premiums are so expensive. What about an old-fashioned interest rate swap? The other thing that attracted clients back over to the swap side of the fence in many cases was the massively inverted curve we had seen. When you're looking at 10-year rates, even 2-year for a while, they're 100, 150 basis points lower than the overnight rate. That represents excellent term value, good relative value on the curve, right? If you can get a 10-year swap or a 5-year swap for cheaper than you can overnight SOFR, that's a good time to consider an interest rate swap, because you basically would have what they call immediately, you'd have positive carry. Right, you'd be getting paid a higher rate than your swap rate by the swap provider until that realigned as SOFR started to move. So we've seen a lot of clients look at that, and some clients, depending if you have deeper pockets, maybe not, maybe you can access other security, but there are some clients who have gotten comfortable with that collateral aspect of it and entered interest rate swaps. So it's definitely something we're asking our clients to consider. Like I said, if your lender does not offer swaps, we can certainly talk to them about that. But there are other ways to procure a swap. I guess one of the other things that we're looking at right now in the market that is pretty interesting is, in the last couple of years, as rates have moved much higher, as we know, some of the new money that we've seen contain high loan floors. Initially, we saw loan floors put in, when rates were really threatening to go negative. Lenders panicked and said, we got to put some loan floors in here. Some of them traditionally had a 0% loan floor to just make sure they would never get in a negative rate environment. As we have moved up, though, lenders have used that to kind of ensure that they're going to make a minimum rate. In other words, that variable rate won't drift below a certain point. So once your loan hits that floor, that's basically the lowest your loan is going to reset at. Now, if you're in a variable rate loan, you don't want that. You'd like to benefit as rates continue to move down. So what we have been selling certain clients who want to offset that floor is, we say, okay, well, you basically sold a floor to the loan provider. You can buy a floor in the market similar to buying a cap, and it basically works the opposite as a cap. As rates move below the floor you've purchased, you get paid that differential. So if you have a loan with a 4% floor and you buy a 4% floor, if rates reset at 350 that next month and you say, oh, wow, I'm not going to benefit from that. Well, yes, you are, because you'll get that 50 basis point payment from the floor provider, essentially offsetting your loan floor and allowing you to benefit from lower rates. We do have an example of that up here. Just to walk quickly through it, we looked at one for a client the other day. They had a $25 million 2-year loan that had a 4% SOFR floor. I just did back of the envelope calculation, say SOFR dropped from 4% to 3%, the borrower wouldn't benefit from that. If SOFR stayed at 3%, right, you'd miss out on about $250,000 in annual savings, or for a 2-year period, over $500,000. We looked at a floor for this client, it was 25 million, 4% floor for 2-year term. The floor price was $154,000. So again, there's no guarantees that you'll need to offset your floor, but these are for, something to proactively, not really manage your risk, but take advantage of a product out there that can help you benefit from lower rates. As we just talked about, tremendous uncertainty. We really have an idea now maybe where the term structure of interest rates is going, but we certainly don't have a crystal ball. So being prepared before rates start to move, similar to a cap, benefits you because once that skew shifts and rates start to move down, floors get much more expensive, right? Because now the bias is that, oh, well, rates may go down, the Fed may be cutting rates, so floors will get much more expensive, and conversely, caps will cheapen up because that volatility skew we're talking about is going to be to the downside, meaning, okay, there's much more probability rates go down than up at the moment, so those products will get more expensive. All right, so I guess to jump into the extension slide, and again, I urge you to reach out to your advisor. Hopefully that's RCA. Each situation is different. Each of our borrowers has a different perspective on rates, may have different cash flow objectives, may have access to capital or something that others don't. So there is definitely no cookie cutter solution. And again, there's no easy solution to this because, going out on the curve and trying to predict forward rates is next to impossible. As I mentioned, I've been doing this a long time. I don't think I've ever seen the forward curve, say, past 3 or 4 months, actually manifest as it was forecast. So I also caution my clients that, if you look at the forward curves right before the Fed started tightening rates, it's a joke how off they were for that next 18-month period. So the situation we have here on this slide, rate cap extensions, review your alternatives, is one that we recently dealt with. It was a client who had an extension coming up and was grappling with, do I extend for 1 year? Do I extend for shorter than that? Like, what do I do? Do I, maybe move my strike if my lender will permit it? So what we suggested is to look at, perhaps looking at the 1-year cap, and this is in the box on this page for the rate cap extensions. We said, let's move your strike to 4%. So if you look at that line, you'll see a 1-year 4% 20 million cap costs $283,000 today. But as we talked about earlier, if you bump up your strike, you have to pay for that additional interest expense. So moving from 2 to 4% adds 200 basis points of interest expense, which, assuming a 3360 calendar, loosely equates to like $399,000. Combining those two, $682,000, which is a known cost for the year. Now, what I caution clients is, look, caps, swaps, derivatives are interest rate hedging products. They're not meant to make money. That can happen sometimes. They're not meant to do anything but mitigate the risk that they're being put up for. So in this case, this client would go to bed that night thinking, wow, I know my cost for the year. I'm very happy with that, and I paid much less upfront premium. I can now pay that additional interest expense over time, which is okay, I can do that. We also showed him, because he wanted to see, keeping the existing cap at 2%, but only extending it for 6 months. As you can see, because of the lower strike, it's substantially more expensive than the full 1-year 4% cap. But again, that's because it has a lower strike. 0 additional interest expense for that first 6 months, because you've now locked in at 2%, which was your existing cap, so you're just carrying on. But the back 6 months is an unknown. Now, you may do this hoping that rates will come down, and they may, but they may not. They may spike up in your face 2 weeks before you're getting ready to do the next 6 months. So that's an unknown. So what I did for the client is just say, look, let's assume that nothing changes in the market. And in 2 more months, in 6 months, you've got to buy that 2% cap again. That's going to probably cost you another $369,000, maybe even a little bit more if bid offer or margins have widened. We'll assume margins have. So that equates, if you look at the bottom graph, bottom box there, to $738,000 if nothing changes. Now, yes, rates could go down, but it would take almost a 40 basis point or 50 basis point move to make up that $56,000 benefit that you see there. So these are the types of things we try to walk our clients through, get them to consider and really think about. Because in this case, the client elected to go with the higher strike 1 year, and was very happy with the decision. Again, I think the thing to point out is here, these are risk mitigating products. So 1 year cap, it's a known cost, you're all hedged up, no more risk for that year. The 6 month, you can play around with the market if you want, and it may go your way, but it may not. So you still have a high component of risk in the back end of that cap. Now that's not to say, that 2 weeks in, you can't buy the other 6 months, you're not bound by any time frame on a cap. But as we've seen recently, rates can change and can change very quickly. All right, so the next 2 slides, we'll just get a, yes, I'm sorry, question.
What did the client do?
They went with the 1 year 4%.
Okay.
Yeah, and just said, look, I'm hedged, my lender approved the higher strike because the cash flow could support that additional interest expense. Because essentially, if they were paying that premium anyway, you're kind of prepaying interest at 2%,
Right.
so the lender understood that, and they were fairly easy to work with when it comes to that. But yeah, they went for option A.
And is that how you advise your client to talk to their lender about that?
Yeah, I would, and again, as I was saying, it depends on the lender. Like, we know certain lenders like some things, don't like other things. And same with borrowers. But until we have those conversations, I think it pays to analyze your situation, talk to your lender and your advisor before you just make like a cookie cutter decision and say, yeah, just roll it for a year at the strike. I think these days it definitely merits a bit more analysis than it say would have 2 years ago when you just would have said, yeah, just roll the cap. It's pretty much zero cost for the most part, the way rates were back then.
Keep in mind, you can always terminate the cap early and recoup any of those extra 6 months if you do get rid of it after 6 months. Which is, the cap has a value to it in itself.
Right.
So the 1 year 4% is giving you the protection at the 4% obviously for the entire year, and if you do end up rebuying or selling early, then you
can sell
the
it.
loss.
Yeah.
And thank you, Marcus, he reminded me to mention that, and I of course forgot. But yeah, when you buy an in-the-money cap, all that premium mentions prepaid interest, you'll see, like if you get a mark-to-market statement a couple of days later and rates haven't changed, your mark-to-market will be positive by almost the full premium amount, less whatever margin they have in the cap. Because that's just going to, and it's important to understand this too, because people ask me, well, how can I predict like how much my cap value will deteriorate over time? It's basically going to be as interest payments are made, the cap will diminish in value until it just has a zero value after that last cap payment is made.
And in regards to speaking to your lender, what we always like to say is caps are a very fluid instrument to get almost anything you want done. So the point is the conversation. I know a lot of what we said over here is quite technical, but from the perspective we want you to walk away from is we can really mold the cap specifications to the needs or to the agreement that the lender is willing to do. So for example, one of the strategies we've seen is like this dollar cost average strategy in terms of, if you, let's imagine you need to extend your cap, you've set 6 more months left on your existing cap. It's a $30 million cap, it has to be extended in 6 months. So what some of our clients have decided to do is, great, let's dollar cost average it. So let's buy $10 million of that future protection today, and in 3 months from now, we'll buy another $10 million, and then when the cap actually terminates, that's when we'll get it approved by the lender, and we'll purchase the remaining $10 million, and that way you're able to take advantage of different market points. And it doesn't have to be in set intervals. So you could decide, let's speed up that process. Rates drop, we want to take advantage, something comes out. So really the 2 things we want to leave you guys with is be in position to execute at any moment. And what does that mean? It means onboard with the provider, be in touch with a company such as Rate Cap Advisors, make sure that all the documents are in and the lender is approved and good to go. And that way we could really move within 15 minutes. If we have all the onboarding done, it takes 15 minutes to 30 minutes to queue up a trade. And the second thing is talk to your lenders. Again, the better relationship, the better the client is with, the relationship with the lender, the more you see them willing to be flexible. So it's those conversations. Don't be afraid to have the conversations. You can reach out to us. Obviously, we have a lot of experience working with lenders that really span the gamut, and from the debt funds to Freddie, Fannie, we've seen what they allow and what they don't allow, so we could obviously tell you a good starting point and ending point, but have those conversations with us, have the conversations with lenders, with their relationship managers, and that'll put you guys in a good position. But think about it, which means really we could get pretty interesting, we like to say, with a lot of the ideas that we work with.
Okay.
Yeah, that's a great point too. I would only add to that, to Mark's point, to be clear, there's no obligation to trade a cap if you onboard with a provider. You could be onboarded for I think as long as almost 6 months without them having to refresh documents. So the only reason we urge that is not to lock you in with that. You're under no obligation to deal that in any immediate time frame. But to Mark's point, which is a really good point, you need to be able to be nimble in this environment. So if you see an opportunity that day, rather than be like, oh, I owe these guys this and we're not, if you're ready to go and say, yeah, let me talk to my partners here or whatever, and we'll be back in an hour, and maybe we'll try to get this cap traded. So you're under no obligation to deal, but it just helps you be more flexible.
That's really it. The remaining pages really are just some marketing tools. Obviously, you can read through them, but the bulk of it is reach out to us with any questions, whether it's defeasance, yield maintenance, caps, swaps, collars. Really, we work with lenders and obviously sponsors that span the gamut. I don't know if there are any questions or if you want to go through the swap pricing quickly.
No, I only wanted to highlight the back second to last slide, current market pricing, because I did this prior to the Fed this page in order to get the submission in on time. I guess the first thing I point out is, as we talked about, you can see that every single swap rate on the page on the top line there is below where current SOFR is. So there still is some inversion to the curve, not as pronounced as it was prior to the last couple of months. Yes, sir.
How are you seeing the rate cap, I guess, intermediaries or providers changing? Like, I know SMBC was obviously the market leader, but now it seems like there's Wells and a lot of other players. And
Yeah, that's a fantastic question, and the answer is yes. The universe of cap providers, derivative providers in general, but specific to caps, is much larger than it ever was.
Thanks to us.
Thanks to us, yes. No, I'm kidding. But one of the main reasons that is previously with LIBOR, when you're talking about 1 month LIBOR, 3 month LIBOR, most banks funded themselves on 3 month LIBOR, but most borrowers borrow monthly. So that created a tremendous basis position. So a lot of cap providers or capital markets banks that you would think be involved in this business had trouble managing that basis risk, and twice in my career I saw mismanaging that basis risk totally implode a desk and shut it down. So a lot of banks and capital markets providers avoided it. With SOFR, there is no basis risk now because they all will back down to that daily overnight risk-free rate. There are some rules in the market about how traders have to manage that risk. So what it's basically done is permitted other banks to get involved in that. And honestly, I think as banks heard more and more about the success of CBA and SMBC and some of the other banks getting in, it's a good business for them. If they can manage the volatility risk, which most banks do, and even if they can't, they'll offload it to another bank, like back to back it. It's a good business to be in because once you collect an upfront premium, you don't have to worry about any credit risk to your clients. But yes, I'd say our universe now of cap providers is about 8 banks, and we're hopefully going to add 2 more soon. And one of them is a big Japanese bank that we're hoping can even go toe to toe with the SMBC.
is a practical difference? I mean, is the competition actually making a difference in the cap pricing, or
Absolutely.
Or is it just?
Yep.
How much is it the fee versus they're just pricing the yield curve and they're all?
Well,
they're
but
all
it
within the
depends.
same-
Some banks are axed for different things. Like we get a Freddie trade come in, there's a bank that we immediately show that to because they are dramatically better than any of the other banks out there. That's the world they stomp around in. They can be very aggressive. They know the risk. And they just consistently blow the doors off of anyone else trying to do Freddie transactions. So there's a bank on the West Coast that inside of 3 years, they're tough to beat these days because they're making a concerted effort to sharpen up as much as they can. Banks look at it 2 ways sometimes. They look at it as, okay, we've got to earn a minimum margin no matter what, and that makes them less competitive. But there are other banks who truly understand how the option, cap market works, and they'll say, well, we can do this for $12K and still have a very good return on this trade, and that's what they're doing.
Especially when they're trying to gain market share, which means, as you pointed out, there has predominantly been one very aggressive bank in the market, and companies, again, John gives himself a little, he's too humble, but John's been instrumental in really getting and adding different cap providers because we have seen demonstrably that the more providers there are, the more some of the, I would say, the the usual shops are getting a little bit more scared of the competition, and they're making sure that it's like any competition is good for the sponsor. So what we try and do is we try and take an active role in competition, and that is to engage with as many different providers as possible. Now, obviously, some people say go with the cheapest, it's going to always be the best. We've just never seen that. We've seen that when we put 2 or 3 shops against each other, obviously they're all approved by the lenders. We're not going to some the corner store in order to procure a cap. These are all rated institutions that are able to do swap transactions. And
Joe's caps.
yeah, Joe's caps are great.
Well, yeah.
Why you guys versus Chatham or Pence versus, like, this is a shameless plug, why should, or
Excellent. So me too.
Let's say, I'm gonna speak up for a second. I know Mark since 2019. He's brilliant, he's gonna take care of you, and he's awesome. So.
Well, I appreciate the blood love. All I can tell you is that I don't want to speak to any one competitor, and this is not the point of this, but I will say as follows: that prior to us being involved in here, the fee structure was very, very different than what it is currently, and prior to us being involved in the market, the providers that were being utilized are very different. And there's a reason for that, and we believe that we're a great part of that reason. So we have added transparency in pricing, and we've added many competitors, and both of those help sponsors. Additionally, it makes brokers look very good themselves. So by coming into the mix, we have been able to bring down fees and also provide a certain level of customer service that maybe some of the bigger shops didn't feel the need to provide because they were so comfortable with their market share. But I can tell you that if you ask them or say our name, they probably will say it through gritted teeth and not just very casually. And there's a reason for that, because we've been successful in what we've been doing. And that's one of the reasons why we work with such a great deal of people at this conference throughout the country.
This is for variable rates. On fixed rates, do the banks do any of these types of transactions? So if I had a fixed rate, is it money possibly, like if I'm paid off, is it money maybe to negotiate some type of discount with them? Or on fixed rates, it doesn't apply at all?
Well, on fixed rates, I mean, it can apply 2 ways. If it's an upcoming fixed rate issuance, you can use hedge products to make sure your rate doesn't go too high, something like that. Same with defeasance. We actually use swaptions to hedge defeasance risk, so if rates are dropping, you make sure you get paid that value and it doesn't derail the defeasance. So, and I guess what we're going to start seeing is what we see a lot of times with fixed rate is swapping back to floating. So you've got a higher fixed rate now, but rates are dropping, you want to get in on that. So they'll quote you a floating rate plus a spread. So they'll say, okay, you're paying 8.10. We can pay you, how about SOFR plus 160? Just throwing some numbers around right now. And you look and say, so, yeah, okay, I'm going to get to pay a lower rate than I'm paying right now on my fixed rate. So you kind of swap back to floating to benefit as rates are going down.
There's another conference or another panel
Okay,
discussion
yeah,
that's happening now.
conference.
So we just want to close out. We don't want to go into anyone else's time, but we want to thank everyone for joining us, asking the questions, and obviously want to take away that if you guys do have any interest rate cap, derivative, defeasance needs, please reach out to John and myself or anyone else on the team that's at the conference. Thank you all very much. Appreciate it.